If you sit at a computer all day buying and selling stocks, options, or crypto, what are you actually adding to the world? You aren't manufacturing cars, harvesting crops, or building houses. To the average outsider, a day trader or swing trader looks exactly like a gambler, sitting at a digital blackjack table, moving money around in hopes of hitting the jackpot. But is that a fair comparison? Do active traders actually contribute anything to the real-world economy? Or are they just financial parasites? Today, we are looking at the hard macroeconomics. We're going to break down the invisible vital services that traders provide to the global economy, how they directly fuel the gross domestic product, GDP, and exactly where the line between trading and gambling is drawn. Let's start with the single most important service that traders provide: liquidity. Think of liquidity like oil in an engine. Imagine you want to sell your car. You have to list it, wait for buyers, negotiate, and deal with paperwork. That is an illiquid market. It takes time and friction to convert that asset into cash. Now imagine the stock market. If a pension fund needs to sell $50 million worth of stock to pay out retirees, or a retail investor needs to liquidate cash for a down payment on a house, they can do it in a single click. Why? Because thousands of active day traders, swing traders, and market participants are constantly standing on the other side of that digital counter, ready to buy or sell every single second. Without active traders keeping the volume high, the gears of the financial system would grind to a halt. Spreads would widen, transactions would take days, and panic selling would be far more violent. The second major value that traders add is price discovery. A stock price shouldn't just be a random number. It needs to reflect the real-time health, management, and future prospects of a company. Active traders are constantly absorbing data, earnings reports, geopolitical shifts, interest rate changes, and commodity supply chains. When a company performs exceptionally well, traders bid the price up. When a company is failing, mismanaged, or fraudulent, short sellers push the price down. This mechanism ensures that capital is directed toward efficient growing businesses that actually create real-world jobs, and away from zombie companies. If you trade derivatives, like options or futures, your economic role shifts from providing liquidity to something even more vital: acting as an insurance provider. Think about a major airline. A sudden, massive spike in jet fuel prices could completely bankrupt their business. To protect themselves, they go to the futures market to lock in a fixed price for fuel months in advance. But who takes the other side of that massive risk? Speculators and swing traders. Traders willingly take that volatility off the plate of real-world corporations in exchange for a mathematical shot at a profit. By absorbing that risk, traders allow corporations to focus on their core business operations without fearing sudden market swings. So, if traders provide liquidity, discover prices, and manage corporate risk, why does everyone still compare it to gambling? Because for a lot of retail participants, it is. If you are entering trades based on pure emotion, social media hype, or a gut feeling without understanding probabilities, you are the player pulling the handle on a slot machine. Statistically, the market will eventually take your money. Economists call this noise trading. But professional, disciplined traders don't act like casino players. They act like the casino house. They build systems based on mathematical edges, like an RSI divergence strategy, a systematic multi-asset rotation model, or implied volatility mismatches. They manage their risk meticulously, knowing that while a single trade might lose, the law of large numbers ensures their edge plays out over hundreds of executions. Active trading is one of the most psychologically brutal, high-risk professions in the world. The reality is that capital gains themselves are just an exchange of assets, not the creation of new physical matter. But the byproducts of that execution, the deep liquidity, the precise pricing, and the absorption of corporate risk, are what allow major corporations to secure the funding they need to build the real-world products we use every single day. If you treat it like a casino, the market will treat you like a gambler. But if you treat it with systemic discipline, you are a vital participant in the global economic machine. What are your thoughts? Do you view your trading as a disciplined business or an intellectual game against the house? Let me know in the comments below. Don't forget to hit like and subscribe for more disciplined market breakdowns. See you in the next video.